You spent decades building your 401k, believing that once you reached retirement, every dollar you'd saved would be yours to spend. But hidden in the fine print of the tax code is a rule so powerful it can turn your nest egg into a taxable burden, and you won't even see it coming. The IRS doesn't wait until you retire to take its cut. It quietly braces itself for your first forced withdrawal, then punishes you with steep penalties and soaring Medicare premiums if you misstep. Most advisors won't warn you about required minimum distributions, IRMAA surcharges, half-year savings penalties, or the pitfalls of last-minute Roth conversions. In this video, we'll expose the 4 fatal traps buried in the tax-deferred promise and show you exactly how to protect your hard-earned money before the IRS springs its silent raid. When you turn 73, the IRS no longer lets you decide if or when to tap your 401k. It forces you to start pulling money out, whether you need it or not. That's called a required minimum distribution, and the moment you miss a deadline, the penalty is a jaw-dropping 50% of what you should have withdrawn. Even if your portfolio is underwater, you still owe taxes on that forced withdrawal as ordinary income, which can catapult you into a higher tax bracket overnight. Imagine a spike in your taxable income, so big it wipes out the benefit of years of tax-deferred growth. And here's the kicker. Those distributions don't just hit your tax return, they can trigger a chain reaction of additional costs you'll discover in just a moment. The moment you're hit with an RMD, it's not just Uncle Sam who gets a cut, Medicare does too. Those forced withdrawals count as part of your modified adjusted gross income, and when your income creeps above certain thresholds, you'll suddenly owe extra on top of your Part B and Part D premiums thanks to IRMAA, the income-related monthly adjustment amount. Imagine expecting to pay $170 a month for Medicare coverage, only to find yourself staring at $300 or more because your RMD nudged you into a higher bracket. That's not a one-time sting. It's every single month for the rest of your retirement until your income dips back below the threshold or until you die. Most retirees have no idea how steep those IRMAA surcharges can be. Move from an AGI of $98,000 to $100,000, and you might pay an extra $1,800 a year. Climb a little higher, say into the $130,000 range, and you're looking at an additional $3,600 or more in premiums annually. That's money coming right off your Social Security check, money you can't opt out of. And because IRMAA uses your income from 2 years prior, the decisions you made in the year you hit 73 will haunt your Medicare bills long after the RMD itself has passed. Alarmingly, many financial advisors focus on the tax hit from the RMD itself, but gloss over the Medicare surcharge entirely. They'll show you how much tax you'll owe on the distribution, but they don't add up the extra premiums you'll pay to stay insured. And those premiums keep rising with your income, creating a tax premium spiral where every forced withdrawal makes your coverage more expensive, forcing you to withdraw even more just to cover the costs. It's a vicious cycle few see coming, because no automated statement will simulate your future Medicare bills. If you've built a retirement plan around withdrawing just enough to cover your living expenses, an unplanned IRMAA surcharge can derail everything. Suddenly, you need to pull more from your nest egg. More withdrawals mean higher taxable income, which means even higher Medicare premiums. And before you know it, your savings are draining faster than you anticipated. And unlike the standard tax brackets, these brackets don't adjust for inflation each year. So more retirees find themselves stuck in surcharges they didn't plan for. Understanding IRMAA is no longer optional, it's essential. You must plan your withdrawals, Roth conversions, and even your Social Security timing with these surcharges in mind. Otherwise, you'll wake up one day realizing that managing your RMD isn't just about taxes. It's about protecting access to healthcare without obliterating your retirement budget. But that's not where the pain ends. Missing a single required minimum distribution deadline can feel like a minor slip-up, but the IRS treats it like a full-blown emergency, slapping you with a 50% penalty on whatever you should have withdrawn. That's not a typo. Failed to take a distribution of $50,000 by December 31st, and the IRS can demand an extra $25,000 on top of the ordinary income tax you already owe. Imagine waking up one morning to discover that half the money you painstakingly saved over decades has vanished, not because the market swooned, but because of a paperwork deadline you missed by a day or a miscalculation in your RMD worksheets. The penalty isn't automatic forgiveness. You either pay it in cash or ask the IRS for relief, and relief is almost never granted without a mountain of documentation proving reasonable error and that you promptly corrected it. Meanwhile, your retirement budget takes an immediate hit because that penalty can't be absorbed by future withdrawals. It has to come out of your existing funds right away. Worse yet, most custodians send only a courtesy email or a cryptic note in your annual statement. They're not in the business of chasing down retirees to ensure compliance. The burden is entirely on you to calculate the correct amount across multiple accounts: 401k, IRAs, inherited IRAs, and execute the transfer properly. And if you miscalculate by even $1, the IRS counts that as an underdistribution and applies the penalty to the shortfall. Even experienced financial firms have seen clients accidentally underwithdraw because they overlooked separate RMD rules for inherited accounts, SEP IRAs, or Roth conversions. The complexity creates countless opportunities for error, and the IRS shows no mercy. And if you try to compensate by taking extra distributions later, that simply inflates your taxable income, potentially pushing you into a higher bracket and triggering heftier IRMAA Medicare surcharges. In other words, one misstep can set off a chain reaction where penalties, taxes, and healthcare premiums all spiral out of control. Most retirees never factor this into their plans, focusing instead on market performance and basic tax rates, only to find that a single missed distribution can derail years of careful saving. And if you think the solution is to push everything into a Roth at the last minute, think again, because conversions come with their own pitfalls, which we'll dive into next. If you think a last-minute Roth conversion will rescue you, think again. Converting your traditional 401k or IRA into a Roth sounds like a savvy way to dodge those dreaded RMDs, and it can be, but only if you plan years in advance. Do it too late in one big lump sum, and you'll catapult your taxable income so high that you'll pay far more in taxes today than you'd ever save on future withdrawals. Worse still, those towering conversion taxes feed directly into IRMAA calculations, driving up your Medicare premiums just as aggressively as a huge RMD would. Here's how the trap snaps shut. Once you reach the IRS's Roth conversion deadline, December 31st of the conversion year, you lose your chance to spread out that taxable event. Many retirees think they can wait until the year they turn 73, see exactly what their RMD will be, then convert everything they don't need to that Roth. But by then, you're forced to take your RMD first, which counts as ordinary income and can push you into a much higher bracket before you even touch the conversion. And you can't convert the RMD itself. Only amounts above the RMD are eligible. So you end up paying a surtax on the RMD, then paying full tax on any conversion above it, double whammy. Even if you manage to convert before taking any RMD, the sheer size of a late-life conversion can backfire. Imagine transferring $200,000 into a Roth at age 74. That entire amount adds to your AGI for the year, potentially jumping you into the top federal bracket and triggering the highest IRMAA tier. You could easily pay 37% in federal taxes plus state tax on the conversion, only to watch your Medicare premiums swell by thousands each year. And because IRMAA uses your 2-year-old income to set premiums, that decision will haunt you long past the joy of being Roth flexible. By contrast, a planned, staggered conversion strategy, spreading modest amounts over 5 to 10 years, lets you fill lower tax brackets, minimize IRMAA surcharges, and gradually shift tax liability away from your later RMDs. But that requires foresight. You must start converting in your late 50s or early 60s, well before required withdrawals begin. Once you're in your 70s, the window narrows and the penalties loom. And if you wait until the last year before RMDs kick in, you'll face two giant problems at once: a massive taxable conversion and an unavoidable RMD, both of which turbocharge your tax bill and Medicare premiums. In short, Roth conversions aren't a free pass. They're a double-edged sword if executed too late. Without an early methodical plan, you'll find yourself trapped between hefty RMDs, crushing conversion taxes, and soaring healthcare costs. That's the quiet rule that can gut your retirement plan faster than any market downturn, because no market crash comes with a 50% penalty or built-in IRMAA surcharge. By now, you've seen how a single tax rule can transform your tax-deferred 401k into a minefield. First, the moment you hit age 73, the IRS forces you to take required minimum distributions, whether your portfolio is thriving or in a downturn, and treats any missed deadline like a crisis, slapping you with a 50% penalty on top of ordinary income tax. Then, those very withdrawals that you didn't even want to make count toward your modified adjusted gross income, triggering IRMAA surcharges that ratchet up your Medicare Part B and Part D premiums for years to come. If you think that's bad, missing your RMD by $1 will only make it worse. The IRS demands full payment of the shortfall plus penalty, and custodians won't chase you to remind you. And while it may feel tempting to solve the problem with a late-life Roth conversion, doing it in one massive chunk can catapult you into the highest tax bracket and trigger even larger Medicare premiums, often locking you into those surcharges for years. None of this is a bug in the system, it's by design. The IRS doesn't need to surprise you with hidden fees. The rulebook is already written. Your biggest risk isn't a market crash or an advisor's error. It's overlooking how the tax code structures withdrawals, penalties, and benefits around the retirement timeline. The only way to beat these silent traps is to plan strategically well before you turn 73. Map out your RMD calendar, stagger Roth conversions over multiple years to fill lower brackets, and model how every distribution will affect your Medicare premiums. Don't let the IRS design your retirement for you. Your 401k isn't just an investment account, it's a taxable vessel with its own life cycle, and every phase carries a cost. By understanding required minimum distributions, IRMAA surcharges, harsh penalties, and the timing pitfalls of Roth conversions, you reclaim control. You transform your retirement plan from a passive assumption into a proactive strategy. So take a hard look at your projections, run the what-ifs, and talk to a tax-savvy advisor who will hold you accountable. Because when it comes to the quiet tax rule that could gut your savings in one move, your best defense is foresight before the IRS springs its silent raid.